Hello, everyone. Good afternoon. Welcome to the panel, CMBS Market Update. Where do we go from here? A little bit of housekeeping before we dive right into the conversation. We want to state that the views that are presented here by everyone are their own, and they don't necessarily reflect the views of their institution. With that said, what I'm going to do is go ahead and let everyone introduce themselves. I don't see Natalie on screen yet, so we'll skip her for now and come back. So we're going to go ahead. Oh, there's Natalie. All right, great. So I figured we'd just be democratic about it and go alphabetical. So if everybody, oh, I'm Lisa Paquette. I'm sorry, I totally forgot. I'm a partner at Cadwalader in our capital markets department. I've been at Cadwalader my whole career and done CMBS for the vast majority of it. And if everyone else can introduce themselves, that would be great.
Hey guys, sorry for the minor delay there. Of course, technology is failing me the minute I need it. I'm Natalie Granger. I work at Deutsche Bank. I've been there for the past 10 years as a part of the commercial real estate team. I head up the conduit securitization transaction efforts.
Chuck? You're muted, Chuck.
Sorry about that. All technology just continues to challenge me in 2020, but I'm in charge of the securitization and warehouse teams in the commercial real estate group over at Credit Suisse. I've been there for about 5-6 years now. Spent most of my time at JP Morgan. Spent 4 years at Deutsche Bank, but pleasure to be here today.
Last name is M. I guess I'm next. I'm Kevin Mamoser with DBRS Morningstar. I head up the new issue side of our CMBS business, covering conduit, CRE, CLO, SASB, Freddie, et cetera. I've been with DBRS and now Morningstar since 2004, and then was at Fitch for a couple years before that.
Hi, I'm Neerul Shah. I'm the Managing Director at Rialto Capital. We are representing the special servicers here. We're named special on over $130 billion of securitized debt. And I have been with Rialto since inception.
I'm Lindsay Stevenson. I'm with Prime Finance, and I source and do credit work and manage CMBS investments.
All right. Well, thank you all for being here today. Really appreciate it. Why don't we dive right in? We've had an election. We've had the announcement of a potential vaccine. CMBS has been a little slower this year than in prior years, obviously. Let's start with issuers. Where do you guys think we're going to do through the end of the year? Increase, decrease, flat? Do you think the election and the pandemic is going to have an effect? Natalie?
Yeah, I think that, obviously year over year activity is going to be down as it has been for most of this year and since the summer. But that being said, it looks like a pretty productive late fall is still happening. I don't think the vaccine or the election has a major effect just because of how our product works. A lot of what's coming out has been in the pipeline for a while now. So we're, not based on what we're planning to do and a couple of other deals that we know of in the market. I think there's going to be between now and year end, somewhere between 3 to 5 billion of issuance. I think in the depths of where we were in, May and June, that seemed like that would be far-fetched to be saying now. But I think because also we've been supply constrained throughout the year, that there's an opportunity here for investors who sometimes towards year end are starting to, fill up their buckets, getting ready to close the books out for the year. There's definitely, we feel more interest going into year end. So we're trying to get out what we can.
Yeah.
Yeah, I think, I obviously agree with all of that. I don't think we might not be as far back behind last year as people thought we would be. We'll be certainly down year over year because I think we were, high 90s, right, in CMBS last year. And I remember the projections because I checked for today. The projections in January had folks kind of already haircutting that to kind of the 70s, right? So a lot of low 70 projections for 2019. So if we hit something, in the 60 kind of area, maybe that's not that bad, just given the big curveball that, we got in the economy in the world with COVID and shutdowns and whatnot. And certainly the composition of all of the products in aggregate. So I'm just talking about CMBS. So the agency space will be, I think, flat-ish. They seem to have really kind of sped up after a slowdown sort of mid-year. And CRE CLO issuance is definitely way down. But guys are coming back out. Shops are, coming out with smaller and cleaner pools. A few months behind where the conduits came out with smaller and cleaner pools. But I agree with Natalie that there's enough, I think, in the time that's remaining, which keeps shrinking every day and every week. But I'm bullish for finishing by December 31 with something with a 6 in front of it, but we'll see.
Yeah, I think it's really interesting to see what's been happening in the SASB market, just with you're seeing more agented deals come around, which is not something that was very typical prior to COVID. Is just a way to for people to get more comfortable with the risk, and so we're seeing some of that, which I think bolstered some of what were the totals for the year that people weren't necessarily expecting to see that come around. But that's definitely been interesting to watch.
There has been a bunch of SASB agented deals, which isn't terribly usual. I mean, I think usually there's like one a year, and there's been like a bunch this year. So now when you guys are looking at origination, with all of the laws that are still in place in various jurisdictions, are you like targeting particular parts of the country? Are you leery of particular parts of the country?
Well, we're definitely
go ahead.
we're more aggressively targeting markets versus probably pulling back or being more leery of certain areas. But it's more local, like you said, jurisdictional than anywhere else. I'm sure everybody's a little bit, antennas go up or maybe a little chill down the spine when somebody mentions Oregon or at least California overruled. I guess they were trying to roll back Prop 13 with the whole real estate tax cap and whatever. And so that, and one good thing that we do know was settled in the election was that did not pass. So nobody seems to be challenging that. So small favors for our sector. But yeah, New York, California, Washington, Oregon, all the states that have these ever-changing and evolving moratoriums on eviction and foreclosure and other things. Everybody's still doing business in all those areas, but just a little bit more carefully.
Yeah, it's continuing to change all the time too. So it is hard to keep track of whose moratorium rolled off and who re-upped. And so, it's definitely something we have to watch and be careful of. But, Oregon, I think, which is the most problematic, there's just not a ton that gets done there anyway. So it's tough to say if that's because of COVID or because it's just not a place we're seeing a ton of CMBS loans coming out of. Aside from the major markets, but it definitely gives us pause in a couple, but it's just continuing to evolve.
Yeah, that makes sense. I don't think I've seen an Oregon disclosure, and I can't even remember the last time that I saw an Oregon disclosure. So, so now do you guys think that the view is going to change with the announcement of a potential vaccine? I mean, it's not through approval or anything yet, but it seems pretty positive. Are you thinking, is hotel back on the table hardcore? Are we all set to go? Are you looking way down the pipeline to next quarter? Chuck, you're smirking. Why don't you go?
No, I mean, my personal view is that no, all positive, right? All positive that, hey, we had an election that seemed to go one way but not settled yet. All positive that the vaccine was announced, but TBD as to how quickly it gets out there. All the things that I think it's all as positive as we could have hoped given where we are. But I think we're going to talk later about just sort of trends and things that were accelerated with regards to usage of office space and demographics and CBD and rural areas, whatever. I think everything that accelerated all of that with this kind of good news might help also accelerate a return to the new normal. But I think the new normal definition is still open.
Huh. Lindsay, are you like looking down the road and more open to other property types?
No, I don't think anything's changed yet, and in our view, at least, I think we still look to the past, right? We don't try to underwrite future income. So I think we're going to need, certain types of hotels, full service hotels, conference hotels, to show that they've, brought back that income before we're going to be able to take them. And same thing with retail that's got a heavy, that's got theaters or trampoline parks, things like that. Everything's going to have to be open for a while and paying before those are welcome back. But that said, there's still, there's hotels that are still doable these days. Some of the kind of drive-by locations or drive-to locations, or even motels, or, I think some of those are still on the table, where you've seen collections remain pretty stable, even throughout COVID. And for retail, there's definitely retail that works. Triple net still works. Grocery anchored still works. You've seen things have their collections maybe drop off, but they've come back, and you've got tenants in their repayment period if there was a deferment. So I don't think vaccine or election changes our view, but eventually the world will open back up to that. But I think they've got to prove themselves out first.
All right, quick audience question, which I'm going to toss out to everybody. On a scale of from 1 to 10, if CMBS's risk appetite was a 5 pre-COVID, where is it now? Natalie?
So asking from like as a lender our risk appetite, or how is CMBS riskiness seen? I think that the deals that you've seen come out post-COVID have been, I know everyone is probably sick of hearing the term sanitized pool, but a lot of those, the problematic loans and asset types were cleaned out almost entirely from what you're seeing being issued. So, and the new loans that are being done at much more conservative basis. There's more structure. We're being more careful. We're picking our spots. So, and there's a little bit more spread there. So I think that CMBS looks pretty attractive right now. Spreads are not too far off from pre-COVID, but the loans, the new issue loans, are definitely looked at from a more conservative eye. So I feel that while the future is uncertain and there's a lot of volatility, there's definitely some credit being given to the fact that the pools that are being put together, at least from the conduit side, are definitely more conservative than they were in February.
I think Natalie makes a very good point with regards to credit, right? So the question is, 1 is the most conservative and 10 is the most aggressive. So if we're using 5 as pre-COVID, obviously March, April, May, June, the curve kind of moves around, right? And so if you look at the conduit deals, we're going to zero in on CMBS, where would I put the metric? For the collateral, say, as an investor looking at the deal, 4-ish. But what that misses are all the loans that are not in that deal at all, right? Because you have office buildings and retail malls, there's leases in place, maybe people are paying, but you can't really refi or sell out of that stuff for a lot of these, properties around the country. And so, if there's a pool where there's like literally no hotels or 1 or 2, and then all that questionable stuff is out, well, then that 4, when you compare the whole pool to apples, if you try to do that, probably gets dragged to a much more conservative number, like 2.5, maybe. Again,
Because you just ditched all those other loans entirely?
Yeah, because all those loans are now just deleted. So overall, again, I strongly agree with Natalie, and we're a little biased because we're both issuers, but that the overall credit profile, when you take into account all of that, would actually be a lot stronger still.
It's like a zero. It's like a 0 for hotel and retail, a 9 for industrial, and everything else is, like you say, like a 4 or 5 still.
What about you, Lindsay?
Yeah, 100% I agree with Kevin. There's those certain property types that everyone wants, and you're seeing some of those structures start to go out the window, but agree, for retail and hotel, the risk appetite is very low, but for industrial and even some better office buildings, you're definitely seeing things start to get a little bit pushed. But overall, I still think it's in a, if it was a 5 before, maybe it's a 4 now. They're pretty close.
All right, so it's time to bring Neural into the conversation. Thank you. So COVID, we've been living under COVID for a while. Delinquency rates spiked. But in October, overall conduit delinquency rates fell to 8.3, which was down from the high of 10.3 in June. Do people think this trend is going to continue? Is this just because we've gotten the workouts done now? Neural?
I think delinquency is down because there is a big group that have been given COVID relief, use of reserves, some sort of deferment, and so they're not delinquent at this moment in time. But servicers are still working through short-term relief packages. And we are at the point, though, where there are loans in special servicing that are going to require a longer workout, a longer-term solution, and more work to be done between sponsor and special. But a lot of these loans were feeling distress pre-COVID, and COVID has accelerated what is happening with the real estate and the collateral in and of itself. And I think there's still some loans that have yet to come. The news of the vaccine is definitely a positive. It gives a little bit of a light at the end of the tunnel, but it depends on how long. To Chuck's point, when's it going to be available? How many people, where? And there'll be a point in which the cash flow isn't sufficient enough to survive long enough. And I think there's still some things to come. So I think it's a mix of both. There's still some short-term relief being given, and there's a lot of longer-term workouts. And those that were in short-term relief are starting their payback periods. And that may be a new kind of component of delinquencies that we're going to start to see.
Do you agree, Lindsay?
I do agree. And I also think, one thing as you look at the numbers is a lot of the reporting that you see is also kind of a mess. And so, servicers are really busy. They've got a lot going on. I don't know how accurate that picture is in terms of what's actually delinquent. There is a lot of that. It's late when they're applying reserves, or it's just not being reflected correctly. And we're dealing with that on our book, quite a bit.
Do you think the real number is higher or lower?
No, I would think if anything, it's lower. I think you're capturing the real delinquent.
Like,
No. I think you're capturing the real delinquent loans, but on top of that, you're capturing some that might be already modified, that there's been reserves or something like that, but it's still showing as delinquent, just the way the servicers report it.
Oh, that makes sense. Well, so now, do you guys both agree that like the easy stuff, it's all been extended and modified, and you're down to a pool of stuff that's going to take a while to work out? Definitely.
No, I still think there's a mix of those that the short-term relief is going to work for. It just may be a different period of time as opposed to April, May, and June. Some are going to hit their seasonality months where the COVID is going to affect them. So I wouldn't say that the easy is done and the short-term relief is done and we're only in the worst of it. I do think there's a mix of the two.
And I agree with that.
Yeah. So you guys have been working loans out now. It's the first real sort of test of the system, I guess I would say, since the downturn back in 2009. Have you guys, after 2009, there was a bunch of changes we made to pooling agreements, right? Because of the lessons that we learned in 2009. Are you discovering that there's things that work well and things that don't work so well? Will we be in for a new round of changes, do you think, after we get through this?
There's some things, there's definitely a wish list of changes. I don't know if it's going to be a PSA thing, but I definitely, think lock boxes, springing lock boxes just don't really work. We've proven that, and DSCR tests are really difficult because you can see cash, NOI evaporate overnight. So it's hard to rely on that as your safety net for rollover. And so, I would hope to see that start to go away and to start to see more hard lock boxes, maybe more for, certain triggers like your major tenant leaving. I'd hope to see, set deposits, even if it's at a discount, a cash discount from what you expected to sweep. I think that's important. Because a lot of times, we're seeing borrowers that are supposed to be in cash flow sweep, and they'll do anything that they can to avoid it. And a lot of times they'll come and say they want to post cash, and it starts a discussion. But sometimes you're in a delinquency, or you have to go into SS to work this stuff out. So that's the wish list, although it's not really a PSA item, but just hopefully lenders are aware of how some of the structure that it goes into most loan docs actually works, in reality.
Yeah, I would agree. I would say that the challenge and the pain point is where the lock boxes don't exist, or you're springing and maybe you don't have the local account and or both the cash management account. There's a lot of paperwork that goes into getting it set up, a lot of cooperation, and where they are not black and white tests, but they're tests led to DSCRs and debt yields. Interpretation comes into play, and it does become a long, drawn out process where I think many thought that the triggers and the cash flow sweeps would really be implemented upon, a black and white event. But what I would say is there were a lot of reserves put in place in 2009, and CMBS is 2.0, 3.0. And the reserves and a lot of what was put into place is really been helpful as we cut through the pandemic. I think there could have been a lot more loans that ended up in special servicing where the use of reserves, and not entirely depleting them, but the use of reserves really did help for some short-term relief to kind of understand what do we all need to get through. Is it a real estate issue, or is it just a temporary cash flow issue? And that, I think, is a positive in some of the changes that we've seen with some of the reserve structures that were really set up at the onset.
I mean, it seems to me like, and I don't know anything about this, I'm negotiating with borrowers directly, but it seems to me, Chuck and Natalie, that a lot of borrowers would push back on hard lock boxes going forward, or are they receptive to it given the pandemic and where we are right now?
I think in the short term, they understand, and that's a necessity. We've been, successful, and I haven't looked at the stats exactly on what we've originated, but we know that that's been a focus item. It is something we are trying to move towards having, for all loans. And in the short term, I think that's fine. That's totally doable. They understand that we're in the middle of a pandemic. We have to have this process in place, especially if they want help down the road from servicers to, if something comes up, have that infrastructure built in. The real question is a year from now, when things are hopefully maybe 18 months from now, when things are feeling on more sure footing and it's a very competitive lending market again, that's one that, since borrowers really, really don't like having that in there, which is why you've seen the percentage of in-place lock boxes at closing go down so far. It's going to start, it's likely going to be harder to hold the line, that 12, 18 months from now, as the disruption is further in the past, loans feel more stabilized, and competition becomes fierce again.
So let's put it off till a later day to hope.
Yeah, for now, sure. They're all going to look great. It's really how we as an industry, who gives it up first, and then the rest of us, we'll end up slowly following suit. I probably shouldn't say that, but that's just the reality of how some of these, how some of these discussions go, and the reality of our product.
Yeah.
Are you the same, Chuck, or?
Yeah, no, I think that's right. And we've already kind of seen it happen, right? When the GSEs came out with their papers and 12-month debt service reserves unilaterally, and when lending stopped and started up again, in our sector there were reserves that weren't there before, and then when reality kind of, to Natalie's point, kind of sinks in, and with the competition elsewhere, right, across the banking sector, which is this huge behemoth, and they weren't moving, they weren't changing, and so a lot of those reserves, a lot of those extra structures already started to kind of move away. I mean, we still have here and there some interest reserves and some modified language, so it facilitates maybe a repurposing of a TILC reserve in the future because of what has been already sort of experienced today, and maybe around the edges of things like lock boxes, we can as an industry account for our experiences here and ensure, to Lindsay's point, moving forward, and Narelle's point, moving forward, that we have something that better anticipates the stress here, that isn't going to push somebody completely away from securitization lending versus balance sheet lending, again, if the balance sheet lenders just aren't making any changes at all.
Right. So Kevin, are you at the agencies? Are you guys looking for anything particular?
Yeah, it's a good question, and sometimes it's people want to know if we're giving credit specifically to loan structure, because if we're not giving credit, the question is, well, why should we do it if we're not going to get anything for it? And it's a difficult question, because we're not giving credit in any programmatic way to sort of loan structure generally. What I would say is, you kind of look at every loan on a standalone basis and try to figure out, what loan structure is necessary for us to think, the loan is originated in a prudent kind of credit neutral type manner. And there could be some properties that have, concentration of tenants in vulnerable industries, or a lot of near-term rollover, different things like that, where having a large upfront TILC reserve, having a sizable debt service reserve isn't sort of extra and special and they should deserve credit for it, but that just kind of gets you back to neutral, and it's just necessary to get the loan done. And in those instances, we're not going to give any extra credit. On the flip side, if we think that there are real issues that are not being addressed by loan structure, we would potentially penalize a loan. And then, of course, there are instances where, you might have a loan on an office building where, the rollover profile is reasonable and the tenancy is strong. And on top of that, there's a sizable upfront leasing reserve. We would give cash flow credit to that. So it really depends on the circumstances. But just having good loan structure doesn't, get you a prize necessarily. It just sort of, gets you to the point where you can make a decent loan, maybe.
Well, I think you should tell the lenders, Kevin, that are giving you a hard time about getting credit, that the elimination of a penalty is a credit.
That's right. Yeah. Yeah. It's all relative.
Whose side are you on, Chuck?
Lindsay, are you guys looking for particular structures, or?
I mean, same thing as Kevin. I mean, if it's a major tenant and you're expected to sweep $2 million before they roll, and you've got a springing lockbox and springing cash management, no, you're not getting credit for that, just because it's just hard to count on it. But if you've got a hard lockbox in place, or you're collecting X amount each month leading up to that, we'll give you credit for it. But we've just been fighting that fight on getting the lockbox set up. It always takes longer than you expect, and then they're always negotiating. It takes 4 months to do it, and they'll contribute maybe 1 month of those 4 months. Everything then is up for discussion. So it just doesn't work.
All right. Well, I don't think I understand it any clearer now than I did before. It's all individualized.
Yeah.
Nurul, you mentioned before briefly, and I want to come back to the point that a lot of the initial modifications are expiring now. People who came in right away in the spring and over the summer who got, I don't know, what was the typical extension? 2 months, 3 months?
It really ranged 3 to 6 to 9. It was circumstantial, and it depend on how the asset performed pre-COVID, sponsor, when it was originated, but, anywhere 3, 6, 9 months of relief.
Are you starting to get people coming back for a second bite at the apple?
Yes, we are. Our payback periods really started with August, September, October being kind of one of the highest months that we're going through, and we're definitely getting asks for extensions. We're seeing some delinquencies, and we'll kind of see how far that extends. But we do have sponsors coming back for further relief, further extensions, further deferral periods, and longer payback periods that are stretched out, assuming there's no jurisdictional issues. And that the answer is it really is case by case. We want to make sure that we don't deplete reserves entirely, and that there is some protection for the bondholders as it relates to lender collateral. And if a sponsor is working with us and coming with some equity contribution and really working towards a plan, that's a different situation in terms of, at the second round, assessing whether or not it's an option that really leverages the loan a little bit more, or adds more risk to the credit, versus, proceeding down a path that the special should take otherwise. So, but the asks for extensions are starting to come, and I think that will continue to increase as we go into the rest of the fourth quarter and into the first of 2021.
Are you seeing the same, Lindsay?
We've only seen, I think, 2 or 3 come back and look for extensions so far, but I doubt that that's the end of it. I'm sure more will start to come up. They just, for most of our borrowers, they just started to hit that repayment period for any deferment. So, I expect some more, but we did really try to go through, as best as we could and identify those that we thought needed more and provide it for them initially up front, but I'm sure it's just the beginning.
So last week, before the announcement of a vaccine, a borrower comes in, but now this week, a borrower comes in after the announcement of a potential vaccine. Are you going to look at the time frame any differently? Are people going to start figuring, okay, if they can get that vaccine up and running in a month and get distribution out in March, so that means X number of months? Or are you pretty much just still same as before?
I mean, I wish I had that great a vision to know when this vaccine's gonna, how well it's gonna work, how it's gonna be distributed. It's still, I mean, the same as before. I think the vaccine at least gives hope that there's, they figured it out, and that some of the borrowers come and say, look, I have X many months left to me. Where before it maybe seemed hopeless, that maybe this helps them, contribute a little bit of equity and work with us. But I don't think it totally changes the strategy.
No, I agree completely. We don't know enough to know that there's a change in strategy. But to Lindsay's point, maybe, it gives a perception or the feeling and belief of hope and wanting to contribute to the collateral versus having no end in sight.
Makes sense. So before, when we were talking about competition, we touched a little bit on sort of the borrower experience. And again, in 2009, we got a lot of borrowers complaining that it was not easy getting through the modification process during the downturn. Do you guys think borrowers are happier this time? Is it going better? Everybody's like smirking. I don't even know who to go to with all these facial expressions.
So we started to talk about this the other day on our pre-call, and one of the things that I think that two things. It's been long enough since 2009, 11 years to be exact, but it's been long enough that even CMBS sponsors that have a big portfolio are suddenly very surprised by how the process works. And it hasn't materially changed. They're very surprised they have a CMBS loan and that they can't just do things like they want to, and that there's fees associated with being in special servicing and other things when you're going above and beyond a simple, some of the simple modifications that we're doing on the short term. So, I think there's.
Uh-oh. I think we lost Natalie.
Yep.
You got muted. I don't know, Chuck, you're smirking. Why don't you jump in?
That's a loaded question for a whole bunch of different reasons, and it's probably, it would probably lead to differing responses from different borrowers. And again, it's borrowers conduit loans that went into conduit deals, borrowers to larger assets that might be in SASB's, borrowers to short-term floaters that would be on balance sheets or in securitization line for this panel, right? So CREs, CLOs, and then property types. Their experience, before trying to reach out for relief or relay sort of the details behind their stress, are going to be very different. And so hospitality is probably one sector that, relative to prior, will come out of this, if you were to ask them, that they've had a worse experience, because a lot of the things that Natalie was talking about, and the fact that it hit that sector so discreetly and so quickly, we talked about the scenario where revenue drops to zero overnight. That never happened before across an entire sector. And so there's been so much congressional lobbying. So I'm a little biased. I forgot to mention, I'm also the outgoing chair of CREFC, so I'm going to give some props to CREFC here, because they've done, I think, a really tremendous job over the year talking to regulators, talking to congressional representatives, and the folks in the Senate Banking Committee, the House Financial Services Committee, with the other trade groups like the American Hotel and Lodging Association, Real Estate Roundtable, all this kind of stuff to try to figure out, okay, this much of the sector is, represented by securitization products that do not have a governing sort of, blanket law or regulation that can cover. They're all transactional, right? Each securitization trust is its own individual contract, and there are limitations and restrictions by whether it's IRS law or other things. And so, all the special servicers have been trying and doing absolutely what they can from what everybody can surmise within the system. It's just that the system went from 0 to 60 in 2.1 seconds.
So I don't want to totally put you on the spot, Neural and Lindsay, but you guys are actually interacting with borrowers. Do you get a sense that they're happy? And I mean, obviously they're unhappy. I mean, coming to ask for a loan modification is never like fun, but any sense from the borrowers about whether it might be going better or worse from their perspective?
I'm not sure if I would say better or worse. To Chuck's point, a lot happened very, very quickly, and you had a lot of people who wanted a voice on the other end, very quickly, and trying to get to everyone and understand what's happening, and doing what we can within the confines of CMBS and REMIC and mods, and understanding of bondholders and what their rights and what they need. It's definitely a difficult situation that you can't just give, you have to assess. And it wasn't like some of the government programs and some of the government backed sponsored deals where you could really take a piece of paper off the shelf and say, here's your program that we're going to do. It had to be case by case. You had to have the conversations. So I think that brought some frustration from the borrower's perspective, in that CMBS was just going to be different. We couldn't do what everybody else was doing right out of the gate.
That makes sense. And you echoed a point that Chuck touched on, the CREFC lobbying efforts, and that we didn't get the same government stuff. So I put the disclaimer up front about opinions, so you're all protected. So, but what's going on now? Are we going to get a stimulus? Is it going to go to tenants, borrowers? What do people think?
We can't even call the election.
Yeah, when the CARES Act got passed in March, like I was looking back at kind of what the COVID stats were looking like then, and that was in an environment where it's like the daily death toll was doubling every 3 days, and it was unclear when that line would stop going vertical, and there was sort of like a pervasive sense of fear, it seemed like, at kind of all levels of government and the markets and everything else. And that was really kind of lighting the fire to get such a massive package done. And I just wonder now, even though we're sort of re-entering another phase where there's a huge amount of cases and the death tolls rising again, it doesn't seem like there's that same level of fear. Maybe it's just been normalized where everyone says, well, everything's kind of getting worse, but then maybe we just do another lockdown for a little while and then it gets better again. You can kind of seesaw. I just fear that lack of fear, combined with the election sort of now being in the past, makes it really, really hard to get something meaningful done.
I mean, I keep making the joke about the election, which is clearly a very serious thing that we're all living through right now. But my personal opinion, again, not of my firm, but if it gets settled, and if it gets settled the way that the press seems to think it will, right, when we have a blue White House and a red Senate and a blue Congress, I would think that it would increase the odds of something happening, size of which TBD, but a little bit less of the full red stop of any kind of plan happening. And it seems like this particular blue White House would seem to want to bend more to get something done with a red Senate than the red White House wanted to bend for a blue House, would be my personal opinion. And unfortunately, we are seeing
confused by the
the upticks of cases and deaths and hospitalizations are very unfortunately going in one direction everywhere in this country. And so by the time this gets resolved in 70 days, that fear, I hate to say it, might come back by then as well, which would help push something like that forward.
I hope rates don't go to that level, that fear is back.
Yeah.
So do people, wild theory, because Trump's in commercial real estate, it was harder for commercial real estate to get a break. Thoughts? No? Nobody?
It's all anecdotal and opinion,
Yeah.
All right, well, we're not even like halfway through the outline and we're running out of time rapidly. So, so talking about the different collateral types, you guys have talked about it a little bit in terms of the modifications and in the origination stuff, but there's a couple of specific questions that people have been talking about, I think, and I'd like to get your take on it. So office, is the flight out of the cities real? Out of urban office?
Yeah, I think.
Go ahead, Kevin.
No, I was just going to say, I think it's probably not really happening. I think there was some good data pulled by Zillow, kind of on the residential side a couple months ago, that showed that with the exception of New York and San Francisco, there wasn't really any urban flight at all. And I think our thought is that, you know, even with some of those kind of gateway markets, seeing some people move out during the pandemic, you know, prices are so high that it seems like if there's a leg down in prices, you just get some people that are willing to take those deals and come back in. And, you know, from sort of a, you know, an office use perspective, at least in Chicago, you know, there'd been a several year trend of major corporations moving from massive corporate campuses in the suburbs, you know, McDonald's or Kraft or Motorola, places like that, Walgreens, and moving downtown. And it was to try to attract young talent that didn't want to have, you know, a horrendous reverse commute, you know, living in the city and then working in the suburbs. And I think that, you know, that trend is probably still there. None of the younger analysts in our office, I think, are very, you know, keen on moving to the suburbs in a, you know, garden apartment complex and doing that whole thing. So I think if the decision makers are still trying to attract young talent, I think the cities will remain very vibrant, I would assume.
Yeah, I totally agree with what Kevin said. And I additionally think that while being at home has taught a lot of companies and individuals that we can layer in more flexibility than we've traditionally had, especially in banking where there was traditionally very little at most places. It showed us that we can do this and be a little bit more nimble with how we work and how we let employees work. But it also taught us that it's really nice to be in the same room and to be able to walk and meet with people and be face to face and have these conversations and meet with clients and be able to hash things out and have that kind of personal relationship that you don't have in other situations. So I think that while the usage might be different, you're still gonna, I don't know, you know, density might be down, but the need for urban office is still very much there. I know that we're focused on, you know, figuring out technology and some of the protocol that we need to figure out to be able to get people back in, but it is something that everyone's looking forward to. Just hopefully, you know, 3 to 4 days a week instead of 5, because my commute sucks.
Yeah. More the Morningstar like equity research folks put out a pretty big, really interesting office report a couple months ago, and it did show, like Natalie was saying, it was almost 50% of respondents to like a big survey that an architectural design firm did, wanted to do, like, you know, 50% work from the office 5 days a week, and then 70% wanted to do at least, you know, 4 or 5 or 3 or 4 or 5 days a week. So the desire is there, and we're projecting that the densification trends that have been happening, where you're cramming more people into less space, probably won't reverse themselves and will continue post pandemic, maybe more gradually, but that's probably not going to reverse itself either.
What about the change in retail to develop everything into a lifestyle center with movies and gun ranges and entertainment and everything else you could possibly think of to do at the mall?
Did you just say gun ranges?
That's why I'm-
I did a
Restaurants
deal.
and gun ranges?
The Beretta store in a mall in Las Vegas has a
And the
gun range.
Palazzo. Yeah, the
It's
Palazzo.
probably next to the axe throwing that has the bar with inside of it.
Yeah. You should see the risk factors I come up with for those things. Are you kidding?
Yes.
Like, did it help? Is it a short-term backfire? Is it still a range trend?
I would say that to say that it was a bad choice almost makes it seem like there was some other alternative out there that possibly would have been better. And looking back, I can't imagine, what that was. So while the experiential kind of businesses are like taken to zero in a pandemic, and the traditional kind of brick and mortar retail is down but not out, I think long term that more experiential stuff probably makes sense, and people want to do those things outside of a pandemic, and that still seems to be a better play than hoping people want to buy socks and underwear at Kohl's instead of Amazon. That sort of seems dead at this point.
Yeah, I definitely agree. I think that the need and want for people to be part of experience retail is absolutely going to come back. It might need to be reconfigured or rethought about ways to do more private parties, private rooms in the short term, but in the medium term, I think that's still a trend that our culture is going to value of having those places to go to meet. We're seeing on where gyms have reopened, collections on rents have been high. People are still looking for those outlets. Those companies are trying to be creative in how they can still create content and experiences for people. And I think that's a trend that will come back. The most worrisome thing that we're seeing or that we're thinking about is what happens with movie theaters. That one is a lot tougher. Converting them to something else is really expensive. They're massive boxes, and I just don't know that even the larger companies kind of survive coming out, whenever it is we get out of this. They've been having, I think, the toughest go.
I think I saw on the news the other day that you can rent the theater for private parties now.
Mm-hmm.
Trying to do different stuff like that.
Yeah.
Interesting to see how that goes. Well, thank you all again so much. We didn't get through a lot of the questions, but we're sort of out of time. Does anybody have any last thought that they want to throw out there, or audience, do y'all have any questions?
Is that a question for the audience? Because I was going to throw out the last thought.
Oh, all right. No, yes, go. Last thought. Nobody's coming with questions.
Well, no, on the positive note, I am very bullish on this whole scientific experiment of 2020. That multifamily is going to be just fine. That the urban flight did happen. The flight out did happen, but the backfill is already happening. Right, roommates are now getting their own apartments because the rents dropped. Right, younger people are being able to move into neighborhoods they couldn't afford before. So maybe there'll be a slight resetting of rents, but occupancy will be fine. I'm not a believer in the permanency of this work from home thing. That I think I make the analogy of the generator. Right, when power goes out, okay, we proved that the generator will work for 8 months now. But you can't hire people off of Zoom. You can't work for people, for 5 years, a business plan off of Zoom. It just doesn't work. And I had a client meeting at 10:30 a.m. in a conference room in Midtown. 7 people there. It was all safe. It was, but that kind of stuff is important, long term. Anyway.
All right. Well, thank you all again. Thank you all for tuning in. We really appreciate it. Take care.